Hello guys and welcome to another Contrarian Goldmine episode. Today we will talk about Diageo. Diageo is the biggest distillery in the world and it's an UK company. Uh, this company start to be on our radar since we discovered that it entered the Berkshire Hathaway portfolio. It was one of the new buys 2 quarters ago from Warren Buffett, and it is one of the top 10 companies of Thomas Gainer portfolio on Markel. It is a really good company with really good fundamentals, and until now it was trading at a premium valuation, but now it's down 20% year to date. So in this video we'll analyze this company, the quality of this company, fundamentals, and in the end we'll do our discounted cash flow analysis to come to a fair value to this company. So let's start. First, I want to mention this is a really good company with a lot of good brands under their umbrella. They sold this is a distillery. They have some premium brands. They own Johnny Walker, Guinness Beers, Tanqueray, Baileys, Smirnoff, Captain Morgan, Crown Royal, Don Julio, which is one of the best tequilas out there, Ciroc, Buchanan, Casamigos, JB, Kettle One, a lot of good brands. That's why they are probably not probably, they are the biggest distillery in the world, and they sold a lot of goods to the consumer. So that's maybe a really why they have a really good fundamentals and a really wide moat. So let's start analyzing this company. This is a $78.5 billion company. At the moment it's trading at a 17 PE and a 16.5 forward PE. They have been growing around 5% per year. This is a mature company, not high growing company. They have really good margins. This is an indicator of probably a really wide moat for a consumer good selling, a consumer defensive. They have really high margins. I do really like this business. I don't like consumer defensive a lot. I don't like there are any good companies out there, but Diageo is one of the companies that has high return on invested capital and really good margins. They have net margins above 20%, which I really like. Their balance sheet is not the best, I have to admit. They have $2 billion in cash and the long-term debt around $90 billion. So if you look into their cash flows have been around 4-5 billion, so they could pay their net debt in 4 years of free cash flow. It's manageable, nothing to worry about, because I do believe with the quality of these brands, since they need a lot of production lines to have these good margins, so they can produce they have a really good manufacturer of this product, so they have been increasing their margins, so they are automating their manufacturers, so they've been investing a lot, so it's really difficult to enter this market and have better margins or a better brand than Diageo has. So I do believe this is an indicator of a wide moat, in my opinion, even though they have not the best balance sheets, but they have been having really nice returns on invested capital, for example, around 50%. The return on equity is around 46%, which is really good. They have been paying a dividend around 2.8%, which is a payout under 50%, which we like. So, and year to date it's down 20%. So really good indication when you look into our checklist. It's all check marks. They are having top growing on their top line around 5%. Is not awesome, but it is good for a mature company and a stable company. Their margins are really incredible. I do really like around 60% gross margin and net margin above 20%. They are having years around 22% margins, which I do really like. Their debt is not the best, I will admit. They have a little bit of debt, but That's normal. That's normal in this type of companies since they need a lot of production lines to automate the manufacture of their products. So I do believe in this type of business. Their competition and the other type of consumer defensive companies, they always or they usually have some debt, so that's nothing to worry about. I do believe this is a manageable balance sheet, in my opinion, but it could be better. They are paying a lot of debt. They are using their free cash flow to buy back some shares, to pay a healthy dividend, and to reduce their debt. So I do believe their management is doing a great job in the last few years. So this is a good point and something to think about. Their management is really good, and this is a wide moat and a really high quality company, in my opinion. So I will classify that with a wide moat. They have been free cash flow positive, and they are been returning capital to the shareholders. They are doing dividends and doing buybacks, and even though they are paying down debt, which is it's something good. They have been growing. This next year will be difficult. They are not analysts are not expecting them to grow their revenue next year. The economy it's not at their best place, so they are expecting their revenue to come 1% down when compared to this latest year, and it's expected them to return growth in the next year. When you look into their shares outstanding, they have been reducing them at a 1.3% average. Their 5-year return on investment has been around 14%. One thing I really like, they have no stock-based compensation. So now this looks really good. Good fundamentals. Balance sheet is okay. It's not the best, but it's manageable. And the rest, I do really like this company. Good margins, good products, good brands. So now the only thing missing is valuation. Is this company trading at a fair valuation? Looking to the 16.5 forward P, doesn't look high, but what is the value to pay for this company? I've done my discounted cash flow. I have assumed growth for the next 5 years around 10% and 6% for the 5 to 10 years. This is a little bit optimistic, but I do believe since we will have next year with no growth, I do believe they can resume some growth as economy starts to be better. That's my opinion. Margins for my base case, I will expect 22%, which is what they are having. So they can increase their margins. They can have some margins expansion since they have 6% gross margin. They could have the net margins could or free cash flow margin could be up until 30% in the next few years if they can manage that and have some cost cuttings maybe. For a PE, I will assume a 19. I do believe they really deserve a premium. Really good management, really good brand, wide moat. For my discount rate, I always try to use a 12%. I could use a little less since I really like this company, but it's always better to use a higher margin of safety here. So with my assumption, I came with an intrinsic value around $98. So at the moment the stock is down, but they are still trading at $141. So for me it's a little bit cheap. I would like to see this company price going down even more. So I might be interested to buy this company at a fair value around $100, $110 maybe. So for now I'll try to be patient and wait for a better entry point, a better opportunity. I do really like this company. I do believe this is a really good company. They are compounding for the last decade. This is a really good company, and I do believe we have to continue to wait for a better opportunity. So I hope in the next year we have the opportunity to buy this company at a better price. So for me it will be around $100. So I hope you find this video useful, guys, and if you like the information, please like and subscribe, guys. Bye.